Everyone. On behalf of Marie Brière and Sophia Ramos, it's a pleasure to welcome you to the first webinar organized by the chair for this 2023 season. I would also like to thank Vanessa Thomas, who's behind the screen, who's responsible for the logistics. So for those who have been following the webinars from the chair, you know that over the last 2 years, we have organized a series of webinars on ESG related issues with a strong emphasis on climate and environmental issues. Today's webinar focuses more on the behavior of individual firms in our society, its lobbying activity about ESG issues, and its misconduct relative to what can be expected from society. So empirical studies often focus on the financial and environmental aspects of firms, but they tend to neglect an important aspect of corporate behavior, which is ethics. Ethics is a key factor when analyzing sustainability and long-term success. Thus, it's a crucial aspect to analyze for a firm's commitment to ethical principle to get a better appreciation of how it manages environmental and societal issues. The two papers in today's program provide new evidence on firms' behavior and the importance of considering these aspects in evaluating the social and governance performance of firms. The first paper, presented by Gosong Su from Erasmus University, examines how firms intervene in the political process regarding the adoption of environmental laws. The second paper, presented by Santiago Truffa from ESSEC Business School, focuses on the misconduct of firms relative to what can be expected from society. And the paper explores the importance of peer effects from board members on the likelihood of firms to misbehave. Santiago hasn't arrived yet, so we'll start with the presentation with Gusong, and Santiago will join us, I guess, as we go along. As usual, participants are encouraged to ask questions on the chat. They will be answered at the end of each presentation. And now I'm turning to Marie Brière from Amundi and co-head of the chair, and I wish you a very good webinar. Marie, it's yours.
Thank you very much, Jocelyn. Very happy to be here. So my name is Marie Brière. I'm head of investor intelligence and academic partnerships at the Amundi Institute, co-head of the ESSEC-Amundi chair of asset and risk management. And it is my great pleasure to welcome you today, together with Jocelyn Martel and Sophia Ramos, to our seminar on ESG lobbying and firms' misconduct. This topic is very important. Today, consumers and employees, investors, they're increasingly aware of firms' misconduct. ESG controversies, such as mistreatment of employees, violation of environmental regulation, are tracked by journalists, and they trigger downgrades in ESG ratings and divestment from retail and institutional investors. And for example, in a recent Amundi Institute paper, we showed that employees react to these controversies when deciding to invest in company stocks. However, ESG ratings and investors often react after the fact. So a key question to investors is, how can you avoid these painful controversies? And are there particular factors explaining firms' misconduct? And one of the two papers will give us key elements of answers on these questions. Another sometimes controversial activity is firms' lobbying. Today, investors focus a lot, as Jocelyn said, on the climate performance of firms. They track firms' alignment trajectories, green innovations, but firms are facing great uncertainty concerning the evolution of regulation. Brown lobbying allows to slow down the adoption of environmental laws and thus protect firms' brown business. A very important question today is, to what extent do firms lobby against climate regulation, and how are investors and stock markets reacting to that? So I'm really glad that we can welcome today two prominent speakers, Gosong Su and Santiago Truffa, on these questions. And let me thank you very much for your participation, but also, of course, Sophia, Jocelyn, and Vanessa for a great partnership between ESSEC and Amundi Institute. And of course, I also would like to thank all of our colleagues and partners to attend the conference. So thanks for being here, and I hope you will find this seminar useful.
Thank you very much, Marie. Gosong, the floor is yours.
Yes, thank you. Thank you, Jocelyn, Marie, Sophia, and Vanessa, for this opportunity to present my study here today. And naturally, I'm feeling very happy to reconnect with the ESSEC community. Let me try to share my presentation. So, right. I hope you can read my presentation. Cool. So this is a study co-authored with our editor Fitch from Drexel University, and our working paper is titled "Involuntarily Green: Corporate Donations to Politicians and Their Votes on Environmental Legislation." Recently, we increasingly hear investors and managers talk about environmental regulations, and environmental regulation is one of the key risks faced by many investors and companies today. This concerns not just lawmakers, investors, also our financial securities authorities such as SEC, and these certainly have implications for corporate behavior, corporate policies. At the same time, what we observe is that over the past decades, companies, especially the large ones, are increasingly engaged in political activities. So we also use the data in our study to estimate that MSCI firms, those are the largest companies, donate about 3 times more money today to politicians. And when I talk about politicians, I mainly refer to the congressmen in the United States. And that's what our sample comes from. They donate about 3 times more money today than they did in early 1990s. So the coincidence of increasing environmental risk as cited by companies and our increasing political engagement by these large firms raises the possibility, which I personally think is not a crazy one, that a lot of companies are using their political power to wield influence over environmental legislation, which is one of the key risks faced by the firms today. But an important question that we do not have a clear answer to yet is, who do these companies support? And especially, who do green firms support? Intuitively, if we believe in the philosophy of doing well by doing good as proposed by Bernabeu and Tirole, we would intuitively expect green firms to support more environmentally friendly politicians. But oftentimes, when we talk to policymakers, when we talk to practitioners, we hear a different story. And probably I'm sure you have collected your own anecdotal evidence about companies saying one thing but doing another. But I'd just like to quote one statement from the US Senator Sheldon Whitehouse. Here he says, "Despite the statements from oil firms about taking climate change seriously, their lobbying presence in Congress is 100% opposed to any action." He also cited 2 good guys, Coke and Pepsi, saying both companies take great positions on climate change in their public materials, but here in Congress, their lobbying agencies don't support their position. And interestingly, about 2 years ago, we came across a Bloomberg article saying that American politicians who vote against climate get more corporate cash. And a lot of this corporate cash is actually coming from the environmental leaders, the green firms. Of course, this Bloomberg investigation uses just a couple of companies from 1 year of data. But that is intriguing, and that kind of motivates us and leads us to ask the question, is this a systematic pattern? Do we observe the whole pattern using a large panel of firms across many elections? Do we still find the same thing? So what do we do in this paper? We first describe a new empirical finding, that is, companies with better environmental performance, and by environmental performance, I mean some sort of environmental rating. You can think of MSCI's environmental rating. They donate more to what we call environmental traditionalist politicians. And by traditionalist politicians, we mean the politicians that mostly vote against the climate. So basically, we are confirming this Bloomberg article using a large set of data and showing that there seems to be a systematic pattern between companies' green performance and their support for traditionalist politicians. But as academics, we are certainly more interested in understanding what may be the explanations behind this correlation in data. So we propose 2 different possible hypotheses or explanations. One is what I call swing the vote, and the other is what I call environmental cost cutting. And I will explain to you in a little bit what this means, and I will tell you what may be the main explanation to this finding. And finally, I will also talk a little bit about the value implications to the shareholders who are thinking about investing in green firms. But before going into the main result, let me just quickly describe the sample and the data, what we are looking at here. We mainly focus on the US public companies that made political contributions from 1995 till 2018. And for each company that we can observe, we measure their environmental performance using MSCI's environmental rating, which I call E-score here in this presentation. We use MSCI's rating mainly because that's one of the most widely used environmental index by investors. And this index is constructed based on firms' environmental performance or risks based on public data, such as corporate disclosure. It does not capture the more hidden political activities, such as political donations that we are looking at. So this allows us to detect any discrepancy between a firm's public environmental performance and their more hidden political activities, which are usually not directly observable. We are also aware of all the shortcomings with these environmental ratings. So in the study, we also use other ratings by other environmental readers. We find very similar results. We also use Ceres membership. That's one of the largest corporate environmental network, and the companies in this network voluntarily commit to net zero. So that's not a rating, but a kind of a voluntary commitment. We find very similar results using this independent measure. So just for the sake of the time of the presentation, I will mainly show you the results using MSCI's rating here today. Now, having measured firms' environmental, at least the public environmental performance, we also collect companies' political giving to each single politician over our sample periods. So these are the corporate political giving through corporate PAC. That's the Political Action Committee, and these data are coming from the Federal Election Commission. These data are available at the electoral cycle level, that is every 2 years. That's electoral cycle in the United States. And overall, we have over 500 firm cycle observations in the study. For every politician that these companies donates to, we can also measure this politician's environmental stance, which we call E-stance, by looking at this politician's lifetime voting records on environment-related bills in Congress. And this data come from LCV. If you know LCV, that's the League of Conservation Voters. That's one of the most prominent not-for-profit environmental organizations in the United States. So LCV basically collects every environment-related bills in Congress for a long time series, and they classify every bill into a pro-anti-environment position. And if you have the environmental position of the bills, we can also observe the vote for or against for this on these bills. And therefore, we can also classify every single vote into pro-anti-environment position. So this allows us to observe, for example, Mike Conaway, he's a House representative, a Republican. Since he entered Congress and until 2018, he voted following LCV's position. You can think of this as a more environmentally friendly votes. Only 6 times out of 359 environment-related votes. That represents less than 2% of pro-environment voting stance. And in contrast, his fellow Republican, Chris Shays, who is also a Republican House representative, followed LCV over 90% of times. So we basically classify, for example, these politicians into traditionalist or activist based on their lifetime voting records. We say a politician is a traditionalist or activist if their cumulative voting records or pro-environment voting records is in the bottom or top decile of the distribution. And we do this classification every electoral cycle so that we have always the same number of traditionalists and activists in every electoral cycle. So any results that I will present you later is not driven by just different numbers of traditionalists or activists.
Can I ask a clarifying question?
Sure.
Is there a lot of turnover
Our turnover, you mean the
In terms
turnover?
of being traditionalists or activists, that these guys change their vote?
No, actually no. And that's probably also intuitive because this sort of environmental stance is pretty persistent over time. So we don't see this sort of attitude changing dramatically from one year to another. So that's actually a pretty persistent classification here.
Thank you.
And as you probably can imagine, we see this, that's the distribution between Democrats and Republicans. We see that most Republicans have pretty low pro-environment voting records. There's just a large number of low voting score, and Democrats is at the other end of the distribution. They have relatively high pro-environment voting records, and that's intuitive. And now the first question is, who do greener firms support? So to understand this question, our basic approach is a pretty simple one and a standard one. We'll use a regression, and we regress a company's percentage of contributions that goes to traditionalists in a particular electoral cycle or to activists in the electoral cycle on company's environmental score. That's the environment MSCI rating. And because you would expect these contributions are certainly correlated with whether the firm is a Republican firm or Democratic firm, if the company has also a political affiliation. So we directly control for their contributions that go to Democrats or Republicans directly. We directly control for that. We also control for other kind of important firm characteristics like size, cash, leverage, profitability, etc. We also condition the comparison within industry or firm by including either industry or firm fixed effect. So in other words, our comparison, we are not comparing an oil company to, let's say, a tech company. We are more like comparing within oil industry, are the green kind of producers supporting more traditionalists or activists? And that's our comparison here. And this is basically the graphs that illustrates the main findings, conditional on the control variables and fixed effects that I just showed you a second ago. And in the left panel, we basically see a more or less linear increasing relationship between these contributions in firms' E-score. If we move from a medium firm in terms of environmental performance to the firm with the highest environmental performance, we see their contributions going to those traditionalist politicians increase by 19%. That's a substantial increase in terms of contributions to traditionalists. Basically, this is the finding of this, also the Bloomberg article that I just mentioned, that greener firms actually give more to those traditionalist politicians. But if we look at contributions to activist politicians, the result is more mixed. Overall, if we want to fit a linear relationship, that's not significant. But interestingly, if we look at the non-linear relationship here, we see that when the E-score is higher initially, contributions to those activists also go up. But when E-score is really high, contributions to those activist politicians actually decrease. And to further reassure you that this is not about political ideologies, we run these regressions tests separately for Republican firms and Democratic firms. We find the same results for both Republican firms and Democratic firms. But what's interesting here is that the sensitivity between contributions to traditionalists and E-score is actually higher for Democratic firms, as you can see a deeper slope here, measuring their sensitivity here. So that's not consistent with this ideology, the results just capturing firms' ideology, right? So now another possibility or concern is that companies are not just donating to politicians based on their environmental stance. They may contribute to a politician based on other policies, for example, taxes, international trade. These are the most important policies that companies care about. And to control for this other policy stance, we also run regressions at the firm politician pair level. So you see we have a large number of observations in this regression. And basically in every observation in this regression is a firm politician pair in a particular electoral cycle. And let's just look at the first two analysis, first two columns. Here, the variable politician flags that the politician is a traditionalist. And the positive and significant result basically says when the politician is a traditionalist and when the firm has a higher E-score, that politician gets more funds from that green firm. No results for the activist politicians. And in the last two columns, we don't classify politicians into traditionalists or activists. We just use their continuous voting score. So a higher score means more pro-environment stance. And we see when the politician has a higher voting score for the environment and when the firm is greener, contributions from that company is lower. And in all these regressions, we directly control for a politician's other policy stance, such as trade and taxes. And we see overall anti-free trade politicians get less money from companies. Anti-tax politicians get more contributions from companies, which also make intuitive sense. But controlling for these other policy variables does not change our main conclusion, that is green firms actually give more to traditionalist politicians. Now, the key question that we are interested in here is what may explain this empirical pattern here. We were intrigued by this finding and we think, oh, maybe that indicates some sort of swing the vote possibility, meaning that green firms are lobbying these traditionalist politicians and try to reverse their votes. In other words, these green firms, they try to turn likely anti-LCV votes, those brown votes, into pro-LCV votes. So that you can think of this as an influence story, right? But another possibility here is that a completely different one is what we call environmental cost-cutting hypothesis. If we assume green firms actually face higher burden from their environmental commitment or regulations, and which has been actually shown in a lot of other prior studies. And this environmental commitment or regulations may be the reason why some companies are green in the first place. But we know environmental commitment or regulations are costly for the firms. And if these costs are really binding for some companies, these firms may try to secretly donate to those traditionalist politicians to reduce their environmental burden by derailing future legislation. And if that is the case, this kind of a similarly green firms, they should actually benefit from some sort of brown bills, brown legislation. So these are two completely different hypotheses, and we try to distinguish which may better explain our main finding. Without going into details of the regressions that I run here, let me just tell you the conclusion. We find no evidence supporting swing the vote hypothesis. Basically, we do not find politicians change their voting behavior, change their environmental stance after receiving more funds from greener firms. And this is consistent with actually a lot of studies in political economics saying that when companies donate to a certain politician, that doesn't mean the firm is trying to influence the politician. Instead, donations mainly reflect existing preference with respect to a politician's existent policy stance. On the other hand, we find strong evidence supporting environmental cost-cutting incentives. So what we do here is that we come up with 3 different proxies for the environmental cost or regulatory cost faced by companies. So we use SEPA, which is the state level environmental law. We use an index to capture the intensity of the state level law. We also use EPA, which is the environmental authorities in the United States. We look at their enforcement actions in the firm's region. And we use these 3 different proxies for the environmental cost faced by the firm. No matter what proxy we use, we basically find the same result. We find green firms that are facing higher regulatory stringency that are driving the main results, that are driving the results that green firms are contributing to traditionalist politicians, which is consistent with environmental cost-cutting incentive here. Moreover, we directly study some sort of regulatory environmental regulation changes during our sample period. There are two important regulation changes. One is 2005 Energy Policy Act, which targets certain industries to improve energy efficiency and reduce greenhouse gas emission. And this allows us to run a classical difference in differences regression here. Basically, the idea here is that we try to compare companies' contributions to traditionalists if they are targeted by the law. So we call these companies treated firms, and the other firms in unaffected industries are what we call control companies. We look at the difference between treated and control companies after the law change relative to before the law change. And this graph basically illustrates the main findings of this exercise. The graph basically plots the difference between treated and control firms in terms of contributions to traditionalists. We see that there's no difference between the treated and unaffected firms before the legislation, the Energy Policy Act. But 1 year after the Energy Policy Act is implemented, the affected firms, treated firms, increase 13% of contributions to traditionalists relative to unaffected control firms. And in the regression, we also confirm that at the same time, these affected firms increase their E-score. So basically, we see that this legislation makes some companies greener, but at the same time, these affected firms increase their contributions to traditionalists after the legislation, which is consistent with environmental cost cutting. We also have a second policy change, which is a very controversial one in the United States, Clean Power Plan. That's one of the most ambitious legislation to cut CO2. But one caveat is that after President Obama signed the plan into law, the Supreme Court put a stay on the law, forbidding the EPA from enforcing the law. However, despite the Supreme Court stay, several states publicly announced that they would continue to implement their CO2 reduction target. Some of the states introduced the state-level legislation to do that. And we use this as a second kind of a law change, and we find very similar results again. So we focus on the states that actually enforce the law, and we find that for the higher intensity kind of a treatment, firms increase their contributions to traditionalist politicians, and at the same time, this legislation makes these treated firms greener. But this legislation is implemented in 2016, so we have only very short one period of post-legislation periods, which could be confounded with some sort of, you can think of some, for example, Trump effect here. So we also do a case study. The case study, what we do is we look at companies located along the county border along Washington, D.C. So the idea here is that both states, Maryland and Virginia, are bordering Washington, D.C. Washington, D.C. is exempt from the CO2 reduction under CPP because there's no electric or generator in D.C. Both Maryland and Virginia are promised to enforce the targets. And therefore, we look at the companies along the border, and if the company happens to be located in Virginia and Maryland, that's our treated firm. And on the other side of the street, which are where we have the companies, in the DC, and they are exempt from the law. If we believe these companies are really close because they are just geographically so close to each other, we run a discontinuity design, and very similar results. We find these treated companies increase their contributions to traditionalists by 12 percentage points relative to neighboring control firms. And that leads to the key message of our paper. We call some companies involuntarily green firms. The involuntarily green firms are the companies whose E-score improves due to mandatory regulatory compliance. For example, the Energy Policy Act or some other sort of legislation. And we find it's mainly these involuntarily green firms that are driving the contributions to the traditionalist politicians, and at the same time, they reduce their contributions to activist politicians. And that really highlights some sort of unintended consequences of environmental legislation. While the law makes some companies greener, but they also drive some companies to donate more to those traditionalist politicians. In further analysis, we also look at who are the main actors behind these results. We look at shareholders, the key shareholders, institutional or mutual funds, for example. We also look at CEOs. And we try to understand, the purpose is to understand who are driving corporate political contributions. What do we do here? For every institutional investor and for every CEO, we find their private donations to politicians. Not the donations through the corporate, but their private donations. For example, we call a CEO as an anti-LCV CEO if the CEO's private donations mostly go to traditionalist politicians. And a CEO is a pro-LCV CEO if their contributions mainly go to activist politicians. And then we interact these anti-LCV, pro-LCV indicators with companies' E-score, and we find it's mainly the anti-LCV shareholders that are driving green firms given to traditionalist politicians. At the same time, pro-LCV shareholders fail to counteract with offsetting donations. One possibility is maybe these green shareholders, they do not directly observe the contributions immediately from those anti-LCV shareholders. But that's the main conclusion here is that it's mainly those anti-LCV shareholders that are driving the results. And in press and in the literature, we talk a lot about the green funds, green investors, but our study here really highlights the role played by some anti-LCV shareholders. At the same time, we find very weak evidence regarding the effects from the CEO, even though there's a weak evidence showing that when the CEO is anti-LCV and when the firm is green, firms' contributions to activists decrease. All right, so I think I need just another 5 minutes to talk about the value implications for shareholders. So far, what we know is that green firms, especially involuntarily green firms, give a lot to traditionalist politicians. And this is mainly due to their environmental cost-cutting incentive. So it's sort of driven by this monetary incentive here. And if this is the case, we would really expect these green firms that donate to traditionalist politicians to benefit from some sort of LCV-opposed legislation bills. We directly study this possibility. We look at abnormal returns. So we look at abnormal returns using the market model on the date of a passage of LCV-opposed bills. So you can think of this as a brown bill that passed in Congress. We look at all brown bills that passed. We also look at the bills that passed with a small margin, 10% or 5% margin. Why do we look at this small margin? Because if most of this legislation, the outcome of the legislation can be predicted. And if that's predictable, stock returns may not be informative. And that's why we look at the bills that pass with a small margin. But no matter what sample we are looking at, the results are pretty consistent. We find that for a firm that is greener, but also contributes more to traditionalist politicians, firm value increases significantly upon the passage of the LCV-opposed bills. And the magnitude here is that for $1 of donation to those traditionalist, firm value market cap increases by above $900 on the date of the passage of the LCV-opposed bills. Next, the last exercise we do is we look at directly elections of those traditionalist politicians. And again, we focus on close races because most election outcomes can be predicted. So if there's no surprise, the stock price is not really informative. So we look at close races using a discontinuity design by looking at special elections in which a politician wins an election by less than 5 percentage points. So you can think of this as a really surprise wins. And without, again, going into details of different regression specifications we run, The main message is pretty simple. Again, we find when a firm is greener and when that green firm contributes more to traditionalists, when their supported traditionalist narrowly wins an election, firm value increases substantially upon the winning of the traditionalist politician. So I guess I'm almost there. Let me try to conclude. The message of our study is pretty straightforward. First, we present our main finding: companies with green environmental grades donate more to traditionalist politicians. And we think that that's not the incentive to swing the vote or to influence the politicians that are driving this result. On the other hand, it's mainly environmental cost-cutting incentives that are driving these green firms to can give to traditionalist politicians. As we see, involuntarily green firms and the anti-LCB investors are driving these firms' gifts. These companies also benefit when anti-climate bills passes and their supported traditionalist narrowly wins an election. And this certainly highlights their environmental performance, or at least public environmental performance, that is in contrast with companies' more hidden political activities. It certainly has implications for shareholders who are thinking about investing in green companies, especially relying on some sort of environmental rating, and it's certainly having implications for environmental legislation. All right, thank you very much, and I'm looking forward to any questions or comments or feedback you may have. Thank you.
Thank you very much, Husong. Very, very nice presentation. Very interesting. I have two questions already in the chat. I'll read them, so it's going to be easier. The first one by Roberto Rigoban. I'm reading. This is fascinating. My question is about the measurement of e-performance. MSCI concentrate on risk, meaning that the measurement has the confounding effect of the regulatory risk and the environmental risk into their score. Rep risk, on the other hand, measures exclusively outcomes, bad outcomes, in the sense that they are all controversies. It would be great to see what occurs to the coefficient. It should be the case that there is a shift in sign to support the cost-cutting channel.
Yeah, excellent. That's an excellent point. So, actually, in the paper we use both MSCI and we also use rep risk as the environmental rating. So our construction of the score is consistent. We just construct the score in a way that a higher score indicates a greener performance. But your comment here completely makes sense. And in the study, we use both MSCI and rep risk. The results are very similar, right? So yeah, I think that's an interesting comment. Yes.
Thanks. Question by Laurent Sodores. A related question to the previous one. Have you tried other greenness proxies like double materiality rating, for instance, provided by S&P?
No, I'm not completely I'm not really aware of this greenness rating, so but I'm noting it down, so I would check if I can have the data and if the data give a very similar result. But thank you for that suggestion.
If I may ask one question related to these two, actually, it's what is surprising in your result, and in a sense, I think very, very interesting. What you show is that these green firms, which are highly rated from an environmental perspective, they give money to these anti-climate guys, basically, and the reason is for cost cutting. So that is for financial reasons, not to improve their image, but it's really for financial reason. In a sense, this is a bit like revealed preferences. Don't look at what I am, look at what I do. And so that means they give the image of being highly green firms, but from an ethical perspective, which is not in the E, but in the S, or they're not doing great in a sense. So I was wondering, I know it's not the object of your paper, but so you have a high green firm, but low ethics. Is that reflected in the ratings? I mean, do you see that? Yeah, it would be interesting to see if they somewhere they pay for it in terms of ratings.
Right, so I do not have a direct answer to your question here, right? So in the paper, we exclusively focus on the E aspect in terms of rating. So we do not actually look at the S aspect. But just to speculate, I highly doubt this S rating, S score also captures firms' actions in a sense that we are especially focusing on this kind of political donations. And I am not sure when these raters actually incorporate these political donations as part of the S rating, right? So that really means that how we should think about this rating. Should we include more broad kind of aspects of firms' behavior in the rating, and what aspects should we actually incorporate in this rating? That's of course a very big discussion that is beyond the ambition of our paper, but I think it's inspiring to think about these questions.
Yeah. But also maybe Guosong, you're not focusing on future rating, because I think I had a similar question to Jocelyn, the fact that maybe when they donate more, maybe rating agencies are adjusting later. I'm not trying to to defend the ratings, but that would be something to check, right? That
True.
there is not a downgrade in the future after after these political donations.
Yeah, true. That's a good point, and we can certainly check if there's any changes of rating about this firm on this.
That could be the object of a second paper to follow up. There's a few comments by Roberto Rigobon. I would like also try with CO2 emissions. We use only reported ones, not imputed ones. Another question by Ayed Gatfawi. Did you look into the environmental granularity? There are many environmental dimensions, and some law focus on part of them from time to time rather than the full environmental scope. So did you look at different types of laws, or you just consider them as, they're all environmental laws?
So we only look at these two specific laws that I just showed you, the Energy Policy Act and the Clean Power Plan. I guess the question here might, if I understand it correctly, so I'm not sure if I understand the question correctly. So maybe what we can do is also to look at different components within the environmental score of a company. For example, emission is part of firms' general environmental score, so that's captured in the E score, but we do not really look at these different components specifically, and that's also a very interesting point that we could look at.
Last point, just wondering how about brown firms? Would they be more worried about environmentally related regulatory policy compared with green firms? The cost should be higher for the brown firms.
Yeah, that's also a very interesting one. So actually our environmental score is a continuous measure. So, I'm talking about green firms all the time, but actually the opposite is actually the brown firms. It's actually interesting because we have to really think about these brown firms and why they are brown. So they are brown, maybe they actually should face higher costs when implementing the law. But on the other hand, they may be brown because they are better at evading different sort of legislations, right? So just empirically, what we observe is that this brown firm seems to donate in terms of less to those traditionalist politicians. But so the reason can be, their existent risk is higher. Maybe they're better at evading some sort of environmental legislation, but it could also be other aspect that we should consider. Yes.
It could be also interesting. Can I ask another question? It would be also interesting to understand better who are these firms donating that much. I could imagine these are less advanced companies in terms of green innovation, so they would like to have more time. So they are trying to slow down a little bit the green regulation in order to let them time to innovate, for example, and then be ready for when the regulation will occur. So again, I'm not trying to defend these firms, but there might be financial reason that you mentioned, Jocelyn, for them to do that if they're not completely ready in the process of greening, right? So they're trying to adjust the speed of the regulation by this lobbying activity. What do you think about that? And another question is also, did you also try to test what the impact of this brown lobbying on the regulation itself? Because you say they don't do that to turn the vote green. So at least they don't succeed to do that. But are they able to slow down the path of regulation? Is there a way to test how efficient this brown lobbying is?
That's a very interesting one. So I have to think about how to actually test it, like in terms of do they prompt more brown legislation in the future. So I don't have direct evidence there yet. But related to your first comment about innovation, actually, there is actually a paper that studies this topic, and they find actually, or at least within some industries, when you think about oil industries, the greener firms actually produce less green patenting than the sort of the more browner ones. Another possibility here is that maybe these green firms, they are using donation to, let's say, to preempt some sort of entry to lobby those the traditionalist politicians to maintain their green status as a sort of strategy to prevent entry, which is also a possibility here. And I think that's also a very interesting angle to think about this brown lobbying.
Okay, maybe a last question? No? Well, thank you very much, Gusong. Very interesting presentation. And now we'll move on to the second presentation by Santiago Truffa from ESSEC Business School, who will talk about firm misconduct. Santiago, you hear me? Yeah?
Yes, I hear you perfectly well. I'm trying
Perfect.
to a screen. Can you see that? So, well, first of all, thank you very much for the invitation. It's a pleasure to be here. I was in Paris in December, and I'm very happy to see some faces again. This is joint work with Matthias Braun and Ercos Valdivieso, and I will be talking today about the social geography of misconduct. Okay, so basically the question that we're after is basically how bad behavior is sustained or is diffused in a society. And there are multiple explanations, all plausible explanations to how this can take place. Is it about institutions? Is it about local culture? Or is it about social interactions? And what is crucial is that different answers might imply very different policy responses. On the other hand, corporate and financial misconduct is an important subject by itself. First of all, because it can hamper market development, and also because in less developed financial markets, it also implies that you're going to have poorer economies, and we don't want that. So, in general, two main answers have been proposed to this question. On the one hand, social interactions or network peer effects might play an important role. On the other hand, and this was basically our motivation, we started with a paper by Parsons and Titman recently in the EF. Local culture, geographical, like there are ethical norms that somehow can be pinned down to certain geographical areas. However, disentangling the role of social interactions from local norms still remains, we believe, and that's what we're going to try to address, an interesting and still lingering challenge. Okay, and so why is this a challenging question? For several reasons. First of all, social interactions and local norms are very hard to measure. In general, we can see studies of this taking place in controlled environments like laboratories, but whenever you want to use somehow observational studies, it's going to be harder to actually observe these things. Secondly, corporate misconduct could cluster within groups of firms, meaning that you could be attributing geographical factors may just be the manifestation of the interaction between particular types of firms in a given region. So there are these confounding effects taking place. And lastly, and not least, Geographical and social clusters could be endogenously co-determined. What do we mean? Workers may sort into places because of their social networks, and concurrently their social networks might be an emergent feature of their social interactions. Okay, the typical reflection problem of Mansky. Now, this seems daunting. What can we do about it? We're going to do our best. First of all, we're going to use what I believe it's very cool new microdata that will allow us to measure social networks at the board level. Okay, that's basically how we're going to address this. We are going to propose a novel measure of social proximity that intends to capture peer effects that rely on past professional background of board members. So we're going to try to see how much they have interacted in the past, and that is going to be some measure that we believe that we are somehow capturing some social types among board members and thus among firms. And we are also going to use bilateral distances among firms. We're going to use their geolocations too. We're going to have a panel structure for identification that will allow us to control for industry, for corporate culture, industry level fixed effects, and we're going to also control for MSAs or different types of geographies. And we are also going to be able to observe and control for several firm and board characteristics. If you think this is not enough, we are very critical with what we're doing. We tried several instruments. Was very hard to kind of get rid of the endogeneity, and so one way to make sure that our results are not driven by endogenous matching of board members and firms, we're basically going to take a structural approach, and we're going to estimate a two-sided matching model that we believe can correct for this endogenous sorting, and we're going to find that results still hold. Okay, it's not that there is no sorting. Of course, there is sorting, but our results are not driven by this particular endogeneity force. General results: a firm tendency to engage in future corporate misconduct increases with its social proximity to firms exhibiting similar past behavior. Meaning I was related to a firm that used to commit some crimes, my probability of committing the same crime in the future, this is crucial, this is not interlocking, in the future goes up, okay? The effects is stronger when the links involve board members that are likely to be more influential. They have more expertise, more business achievements, or they participate in multiple boards. It is also higher when the conduct is less likely to be detected, when neighbor firms were not heavily penalized, and when firms are were already committing misconduct. Okay. As I was saying, a structural model estimation shows that while selection is relevant, results are not driven by this endogenous matching. These effects are independent of that of local and industry norms, for which we also provide evidence. We're not going to say, hey, look, it's this or that. These effects cohabit and are both very important, okay? And overall, our results suggest that a mechanism in which board members learn from the conduct of prominent directors that are close to them, decide whether to follow their actions, the penalties could fail. I mean, our results basically tell us if we were to focus on certain crucial directors, this is one way of sort of limiting the diffusion of bad practices, okay? Some related literatures, this is a question that has been somehow overtaken by accounting, economics, and finance. Our contribution basically to economics, first of all, we provide a rich social network and novel measures of spillover effects for certain, I would say, firm members that are very important. Board members make decisions that are substantial to what firms eventually do, and so this is an important and very relevant type of network that we are analyzing. And we also provide a new approach to kind of understand economic geography and its relation with social network. We're going to try to disentangle these two. And to finance literature, we're looking at very recent question, somehow trying to get at the mechanism, because why do we find these effects that are somehow localized at geographic levels? How much that is driven by the influence or the interactions among members, and that's, we're trying to somehow open a little bit what's going on there. Okay. Let me talk a little bit about the data, then about methodology, results, and I'll try to conclude. We're going to use a bunch of different data sets. First of all, CompuStat. We're going to have a panel with the universe of firm year observations in the CompuStat annual file, going from 2004 to 2017. We're going to use some ESG scores too, provided by Bloomberg, and we've taken that approach. I can talk about that at the end, but that's a different project nowadays. To measure misconduct, we're going to use a database, a very interesting database called Violation Tracker. So we're going to identify corporate misconducts. I'm going to use this CM to refer to corporate misconduct, which are going to be events on the Violation Tracker file. It's going to cover different types of offenses related to banking, consumer and labor protection, some environmental. So this is a very good source of information to look at precisely ESG, for example, price fixing, bribery, among others. Okay. The cases considered correspond to claims resolved by more than 100 federal regulatory agencies. We merge this data with the CompuStat file, and to give you some idea, we're going to have an unbalanced panel data set composed of almost 40,000 firm year observations that comprises around 5,000 firms during a period of 14 years. Okay. So here, for you to have some idea of what are the type of offenses that we have in this violation tracker, we're going to have things like work safety or health violations, railroad safety violations, environmental violations, and things like including payday lending violations, sexual harassment. There's a whole bunch of different type of misconducts that we're going to be able to look at. Okay, in order to build our social network, or to get at this idea of disentangling spillover from just regional effects, we're going to use Bordex. So Bordex is basically an individual network file that compiles the full employment history of director and senior managers working in around 18,000 companies worldwide. Okay, we're going to focus on the employment history of directors, which includes their experience in any board position. That is, from Bordex, we focus on those individuals that have been that have been part of a board in the past. The final network data used in our study comprises the job records of around 177,000 board members, with more than 15 billion bilateral distances among them. Okay, so this was very heavy. Past overlaps allow us to control for confounding factors beyond the conventional fixed effects. So we're going to look beyond whether you are at the same moment part of the same board, like an interlock. We're going to be able to kind of build a measure of intensity, because we're not only going to look at whether you interacted with someone in the past, but for how long, for what period of time you were exposed, meaning that it's not only an extensive margin, but an intensive margin that they're going to try to control. Okay. What we're going to do, first of all, we're going to build our misconduct measure, our corporate misconduct. It's going to be a variable that's going to, each year T, a firm I is going to be as committing some type of misconduct if it was penalized over the year, and zero otherwise. Okay, so as simple as it gets. Then each year T, we're going to construct a firm level social proximity matrix among the N firms in our sample. How we're going to do that? We're going to aggregate the connections between directors of firms I and J arising from historical past overlaps through their board experiences, okay? Director connections are going to be weighted by the correspondent overlapping numbers of years to capture the extent to which two directors have interacted. So to give you some idea, for example, we have four directors, S, E, M, B. They are not connected. Yeah, now in period T, between T+1 and T+2, B and M coincide on a board. They coincide on a board in a second year. That's our measure by the third year of the social connection between these two firms. It's equal to 2. Okay, and so that way you can have some idea of how we build this connectivity measure. What's crucial, given that we are somehow trying to look at the different effects of geography, which might capture, if you want, local norms and things of that sort, from just social connections. This is for a couple of very, very salient firms, Apple. You have somehow where is that firm connected by this director measure, and what's crucial here is that we have that these two things, although they coincide, there is a lot of variation in terms of geography, meaning that you are connected to board members that are not only located very close to you, but you're also connected to board members that are in the East Coast, in Chicago, in other places too. And so we're not just measuring the same thing in different ways, but we're capturing different sources of variation. For the physical proximity, we're going to use geographical coordinates using the typical Haversian distance to compute geographic distance between firms' headquarters. And we're going to define the physical proximity between firms I and J as the inverse of the geographic distance, okay? So nothing new there. Now, to give you some idea of this board-induced social network, on average, each firm is socially connected to another firm by 1.3 board members, okay? Each of these connected board members will establish on average 2.1 connections to board members at the connecting firms, and the overlap on average lasted around 4.4 years. On average, each firm is connected to around 121 firms in the sample, and the number of connecting firms varies widely in the cross-section. In some cases, you can get more than 160. It's also the case that and this is why we care about endogeneity, data suggests that firms connect to other firms with very similar fundamentals. They're more connected if you are within the same industry. You're also more connected if you're in the same geography. The data shows that a large fraction of firms connecting do not belong to the same industry headquarters. They reside in different locations. I mean, there is a lot of coincidence, but it's not. It's more than just that. We're going to build then a measure now that we have this board-to-board measure of connectedness. We need to bring this at the firm level. And so what we're going to do is that we're gonna use both our proximity measures described already and our exposure measures to misconduct. And we're gonna basically build this measure of how exposed you are to board members that have committed or not misconduct in the past. And so basically what we're gonna have is that MJT is gonna be defined as the misconduct measure observed over a time window of 3 years before the event, so T-3 and T-1, okay? And so it's a 1 if that firm committed some misconduct or a 0 otherwise, and that is basically multiplied by my connection to that firm. And this is, of course, normalized to my connections to all firms, okay? And so that's basically how I socially exposed to misconduct and how I am geographically exposed to misconduct, okay? To past misconduct. That's crucial. And we're gonna do something very, 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 for completeness, we're gonna build 2 measures also that are basically gonna look at MSA level, whether this happened or not at a given MSA, and how am I exposed also at the industry level. Okay, so because we have all these competing explanations happening at the same time, and so basically we're gonna also have different measures for this, for how am I exposed at the industry level and at the local level. Okay, so it's not just that I am controlling for MSA and how exposed I'm at the MSA level. We also within MSA know how far away I am from the other firm, meaning that although you're in the same city, if you're neighbors, you could be interacting much more just for the fact that you're neighbors. Okay, and so we're going to be able to get at that specifically and take tear those two apart. Results. Basically, our benchmark model is going to be an equation like this one, where we're going to look at whether you commit or not misconduct at time t, where we're going to have, on the one hand, social peer effects, that is this measure of exposure to misconduct by my social connections, geographic peer effects, which is how sensitive I am to my geographic past connections, local norms, industry norms, and then we're going to have firm level controls, which include firm size, age, ROA, cash holding, so on and so forth. And we're going to also have ESG analyst board, IIT, containing firms IAG disclosure, analyst coverage, information, etc., etc. So we're going to have a bunch of controls in order to try to get at hopefully, if you control for enough things, you get rid of endogeneity as much as we can. We're going to run a login model with its effects, estimated at the pool. We're going to use pool data coefficients, and standard errors are going to be clustered at the firm level. What do we find with different specifications, with different sort of controls? Mainly, there is a positive. There is at the end of the day a positive spillover, meaning that if my peers, my social peers, committed some misconduct in a firm related to me socially, then the probability that in the future I will commit misconduct it's higher. Okay, this is sort of and it's not that social, is it whether geo or board or location. All these effects seem to matter a lot, but independently. They are basically playing out through different channels. Okay. Now, in order to get some idea of what these numbers mean, because this is a long, to give you some economic interpretation of our results, basically, one standard deviation increase in my exposure to boards committing more misconduct means that the probability that my firm is going to commit misconduct in the future goes up by around 8.5%. One standard deviation increase in the geo, in how exposed I am to firms that are close to me committing misconduct, means that my probability of committing misconduct will go up by around 2.1%. Okay, and this here you can see also at the local area. If more firms are committing misconduct in my MSA, my misconduct will go up by 1.6, and at the industry level also my probability is going to go up important. Okay. We're going to try to get a little bit into the mechanisms. In order to have a better graph of these mechanisms, we're gonna look at the heterogeneity in terms of the characteristics of board members and firms. And so I'm running out of time, but to give you some idea, we're basically going to run the same regressions, the same baseline regression I already showed you. We're going to say, look, if I were to split my sample between those board members that have higher achievements, are older, have more expertise, are part of multiple boards, are the effects going to be stronger for those type of connections than in general? And the answer is yes, indeed. This exposure to your boards is going to play a higher role whenever you're looking at board members that have more expertise and might be more influential with their peers. Okay. Now, to address the endogenous sorting challenge, and I'm going to have time to go into detail here, but we're going to use a model a la Sorensen, 2007, where basically the structural model, to give you some sense, is going to exploit the fact that a director decision of where to work depends on other agents in the market, whereas firm misbehavior is independent of other director characteristics. So the probability of you being part of being matched, how you behave, does not depend on other directors' characteristics, but your probability of being matched does depend on other director characteristics. And so the model basically, the structural estimation, somehow exploit features of other directors in the same regional markets in order to get a destination. The model is estimated at the firm director level. So basically what you do, there's like a dimensionality problem or occurs in terms of you estimate all the possible combinations between firms and directors. And so if you have, I don't know, 10, imagine that's 10 to the power of, so what we're gonna do, and this was as a consistency, we're gonna restrict our sample to two main states, New York and California, and basically because given these dimensionality curves, estimating the same model for the whole sample was computationally very burdensome. Now what is cool about the model is that basically it allows us to turn on and off the endogenous sorting. So first of all, we're gonna test whether it's non-random, the features of directors and the feature of firms and how they match. And we do find evidence that matching is not random. This kappa parameter here, it's very big and statistically significant, meaning that directors are not randomly distributed among firms, which is what we expect. Okay, and we would like to see it's basically what would happen to the outcome equation, which is the same equation that we had before, if we were to this kappa put it equal to 0. If we were to turn down this endogenous matching effect, we want to see what happens to our estimation. And so we run the same specification that I already showed you, and basically we find that the results still remain. Even in the absence of this endogenous sorting, there are important spillover effects going on at the board level, also at the geo level. Okay. Yes. So some further results. How am I doing in time? I almost have a minute. We're going to look at different types of misconduct. So you might say, hey, maybe this type of violations are different from those other types of violations. And so basically, we're going to find for employment, environment, safety, the results are still there. Okay. Is it different from interlocking? It is different from interlocking. Interlocking still matters, but this past overlap seems to be we're getting at something very different. Okay. Finally, and this is a very good comment that we've been dealing with. Maybe it's not just about behavior, but it's also about getting caught. Okay, and so we've run different specifications on how to deal with that. One that I like a lot is that we've been focusing a lot on earnings management, which is something where this type of error shouldn't be as strong as for the other type of misconduct, and still looking at earnings management and doing the same specification with this type of misconduct, results still hold. Of course, the size of the effects sort of vary by type of offense, but it is still the case. I mean, it's not a story only about whether you learn or not how to get caught, but there seems to be a diffusion of practices, which is what we care about. Okay, and so to conclude, it's not one or the other. Both norms and social interactions seem to matter for firm decisions. This is, although there is endogenous sorting and we care a lot about that, it's not driven by that. Results still hold if you try to control and follow different type of approaches in order to see how robust this is. Knowing how norms affect behavior helps predicting what will be the effect of different standards. And as I was talking about policy, it seems that somehow targeting very crucial directors might be a way of either hampering the promotion of bad behavior, or as we see, for example, let me do some shamelessly self-promotion here. We've been looking at ESG by itself, and we see also that ESG is being positively transmitted through these channels too. And so we look forward to your comments and questions, and thank you very much for giving me the opportunity of showing you my work.
Thank you very much, Santiago. Very interesting presentation on very important topics. Questions from the audience? And I'll start with one. When I was reading your paper, when I looked at table 1, which gives a list of offenses, it's a long list, and there's 74 possible offenses. Some are very far from each other. Some are very important offenses, and if you look at the average cost or the penalty associated to some offenses, it's very high. Some are very low. So there's a big heterogeneity in terms of all the offenses that you take into account. And so then you say, okay, if you increase proximity, basically, of CEOs that have committed offense, that's going to increase the probability that your firm will commit an offense. But the question I was asking myself is that, so what is that relationship? I mean, is it by type of offense, or what I mean is there a one-to-one matching by types of offense? What I mean by this is, suppose I hang around with a bank robber. Does that increase the probability that I rob a bank, or increase the probability that I, go through a red light on the street? I mean, these are two offenses, but they're not the same level. And so but I think that comes from the heterogeneity of your type of offense. So I was wondering if you try to restrict it to important offenses, if you still get, or maybe you get stronger results, actually. I don't know.
We did that exercise. We restrict to type of offenses. So, like, let's say general labor, general environment, like you can try to group them by topic, and the effect is a little bit lower, but still it is still there, because you wonder, is it that I learned to do something wrong, and then this is learning from one to the other, or maybe I figure out that if we do this, we don't get caught. Or we get caught and the penalty is so low, but it's more profitable to keep on doing it that you want to keep doing it. Okay.
Yeah.
So what we find is that overall, the effect of just if you group them all together, the effect is bigger than if you were to separate them, and that might tell
surprising, actually. Yeah.
Yeah, and that might tell you a little bit about there is this part of maybe they're learning. So how to what's the name of that series of the professor getting bad? You learn to be bad, or you learn that being bad might be profitable on a more general sense.
Okay. Other questions?
Yes,
Marie?
maybe I can ask a question for practitioners. So if you were willing to forecast which firms will conduct misconduct, what would you use as explanatory variables? So we see the importance of the social effects. Are they first order, second order? I mean, the effects looks relatively small and between 1% and 8%. So, but I don't have orders of magnitude. So compared to other factors like corporate culture, the national environment, could you give us a sense of what investors should look at, what allows firms to misbehave in a sense, and what are the most important factors in that?
So this is, I mean, for a practitioner, like if you were to build these variables as some type of explanatory variable, they would matter. How much they would matter, and this is a typical trade-off, right? Is this effect too big? Nobody's gonna believe it. Is it too small? Nobody's gonna care. 8.5, I believe it's an important effect. But for example, there are some industries. So some industries fixed effect, things like that. If you were to make only prediction model, are more important than this spillover effect at the board level. Meaning it's not that it is irrelevant. There is, so people are learning from each other, which is interesting. But if you were just to run a prediction model, industry, firm, age, size, those things matter more than the effects that I'm showing.
Thank you.
Question?
I just have a question also. So thank you for the presentation. So more recently, there has been more recent data, for instance, the data on controversies that highlight this kind of misconduct to the public and to companies. Do you think there is a change over time given to exposing more this kind of misconduct?
So whether like our effects are time varying, that's we did look. So it seems to be more relevant. We look at lags, okay, and they seem to matter. But let me. I think we could do something about trying to find like heterogeneous effects in time, like whether my data are changing in time. That would be super interesting. Yes, saliency seems to be crucial, especially for some type of offenses, environmental offenses. Saliency seem to matter a lot, and that's basically consistent with the story of whether more people follow your company, and there are more like there's more information. Firms seems to be very sensitive to that. But let me. I think that's a great suggestion. I'm going to take a look at it. So yes, thank you very much.
I think I was wondering also, it's related to ESG ratings. You'd think this companies, they're concerned about their ratings. I mean, that's very important. On a governance point of view, you'd think, well, if you should be careful on who you put on the board, because clearly that's going to have an impact on how the firm behaves and is perceived by the public and the rating agencies. I presume rating agencies look at this. So basically what you're saying is that companies should be much more careful when they choose board members, because that's going to have an impact on what the company is going to do and how it's going to behave and how it's going to be perceived by the public.
And moreover, your board member friends do matter for how he might behave. So tell me who surrounds you, and I tell you who you are.
That's right.
That's kind of the story we're trying to tell here. Indeed.
I don't know if you discuss with board members or CEOs, or are companies aware of this?
I don't know. I'm of these effects, like I don't know.
Because I mean, there's important implications in what you say. I mean, you have to be very careful on who you put on the board and people who surround you, because based on their past experience, that's going to have an impact on the firm's behavior.
Yeah. No. I haven't been able to talk to some board members. That's something.
It would be interesting to see how these people perceive this. Obviously, they're they're not in a position to reveal that they're behaving like this, but if that's what you observe, that should be interesting to see what they think about it.
I mean, what we do know, sort of idiosyncratically here in Chile, where I'm at, knowing people from boards and things like that, and that's sort of the idea that we had in mind is that if you are in a board and you misbehave, there are social sanctions associated with that. Like you are part of the golf club, or you go to a church, things like that, and all of a sudden it comes that you're involved with some scandal. People, like, there are ways of how society somehow can induce order into the behavior of directors, and that's why we put so much attention into this geography, industry, because we believe that those are important mechanisms that do hold, that still play an important role, consistent with Parsons and Tillman. Okay, the thing is that we wanted to go beyond that and try to see whether personal relations could also tell us something about their behavior, and they seem to be as important as these sort of local norms.
Okay, other questions? Good. Well, I guess it's time to thank both presenters, Gusong Su and Santiago Truffa. They're two very interesting presentations on a very important topics related to ethics, ESG, firms behavior. Just for an announcement, obviously, I would like to thank all participants, and there were quite a few participants today. That's very nice. Thank you all to all of you. For your information, the next webinar will be on June 28th, same time. It's going to be on ESG and value chain. A different angle again to look at ESG, and that's there's going to be two presenters, Guillaume Coqueret from AM Lyon Business School and I Lu from University of Toronto. You'll be informed. You'll soon receive a mail with the information on this. So we look forward to seeing you in 2 months. In the meantime, once again, thanks for the presentation. It was very inspiring, and I hope to see you next seminar. Thank you, Marie, Sophia, Vanessa, and all participants. Take very good care and see you next time. Thank you very much.
Bye-bye.
Thank you.
Thank
Thanks,
you.
everyone.
all.
Bye-bye.
Bye-bye.